Over a tiny 4-hour window, an astonishing $1.4 billion in bearish crypto bets completely evaporated. This dual-line chart shows the exact catalyst for that wipeout. Bitcoin ripped past $69,000, pulling Ethereum up for a mirrored 20% surge. This rally bypassed the typical crypto catalysts, like new ETF approvals or retail investor frenzies. The actual momentum started in a sector far removed from the blockchain, the US Treasury. All that crypto market chaos traces back to the halls of the United States Treasury. Tracking blockchain data is no longer enough to understand volatility. To find the source of these price swings, we have to look at bureaucratic government actions. The Treasury Department announced they are doubling their long-term bond buyback operations, increasing their individual purchases from $2 billion to $4 billion. This illustrates a mechanical truth of the bond market. When the volume of government bond purchases goes up, it forces yields down. By doubling down on these purchases, the Treasury uses an artificial way to suppress interest rates, inflating bond prices regardless of market demand. With yields suppressed, these bonds offer lower returns, making them less attractive to the institutional funds that typically hold them. This intervention effectively pushes institutional capital out of the bond market and into riskier asset classes like equities and crypto to find profit. That displaced capital flooded directly into risk assets, creating a massive wave of sudden liquidity. Short sellers, betting on a downturn, were caught off guard by this influx, triggering the automatic liquidation cascade that wiped out over $1 billion. This hunt for yield even swept up unrelated stocks, pushing Tesla up over 4% on the day. But this liquidity-driven surge is meeting significant resistance, primarily from a deep sell-off in the traditional tech sector. While Bitcoin climbed, tech giants like Nvidia, Broadcom, and AMD all traded lower, suggesting the market's gains are not supported by fundamental corporate strength. Internal friction is also mounting at the Federal Reserve, where a minority of members are still calling for rate hikes, while the majority pushes for a pause. Additional friction comes from the threat of intensified economic warfare, as Donald Trump warns of crushing penalties for any nation aiding Iran. These threats of severe financial sanctions create a climate of geopolitical uncertainty that directly counters the Treasury's push for market optimism. The market is currently caught in a tug-of-war. Artificial government liquidity is pulling prices up, while tech sector sell-offs and the threat of new global sanctions pull them back down. These government liquidity injections currently have the power to override standard market fundamentals and corporate earnings. In the short term, this influx of cash is effectively masking the risks of high interest rates and geopolitical conflict. This timeline shows the Treasury's buyback program acting as a safety net for the market, running from September 9th through November 4th. But the upcoming PCE inflation data, the Fed's preferred measure of rising prices, threatens to break through that safety net. Volatility metrics like the VIX are already beginning to climb as investors prepare for the collision between this artificial liquidity and the reality of persistent inflation. Investors must recognize that the most powerful force moving crypto and risk assets today isn't tech innovation, it's the bureaucratic officials inside the US Treasury.